All right, welcome to today's webinar video on option activity basics. So, full disclosure, I gave this webinar Monday night, and was a great webinar that we gave Monday night. But I realized halfway through that I or someone, I'll blame it on somebody else, forgot to hit the record button halfway through. So I know the majority of you who sign up for webinars, it's tough to make them. The one that we had the other day was right after the close on Monday, so that's a tough time for people to make. So what I'm going to do is just and I should be able to run through this a little bit quicker. And let's face it, sometimes when you do these webinars twice, they come out a little bit better. So you'll have the extra improvement on this webinar as I'm going through it twice, and it should be a little bit quicker the second time through. So the reason why I decided to do this webinar is because oftentimes in the trading room we're going through things very quickly, and we're trying to catch moves, and I don't have the time, especially when it's, sometimes we'll get the questions between 9:30 and 11:30, which is a busy time. You don't have the time to kind of go through all of the parameters behind each particular trade and why it's interesting. And then we've also had a number of new members join us recently, and some of them have never traded options before. They've traded stock before, but they want to get a little bit more used to trading options. So you have to know a little bit of the lingo. And if you are new and you see this type of language on Twitter when people talk about, oh yeah, that order was swept, that was a risk reversal, no, it was a buy right. These are all things that we're going to go through. We're going to break this down for you so that you get a clear understanding of what this means. So, there's when I used to trade for institutionally, which I'm going to get into my background and so forth in case you're not familiar with my background, but I used to always find it a little bit funny, and a couple of guys on our desks, we used to make fun of one another or other traders when we used to always use trader speak to try to sound cool. I used to kind of break it down sometimes, especially when we had like a newer salesperson, and I would just say, rather than, they would say, hey, they would pay here, or they would do this. Let's just say, hey, do you want to buy here or do you want to sell here? What is the client looking to do? Rather than use the fancy trader lingo, because sometimes things get confused. So that's basically how I'm going to go through this. You have to have a good understanding, and then you can use the fancy terms and know what they mean, but you have to go through, because sometimes people don't know and they're too afraid to ask, and then they don't get a clear understanding, which can translate to your bottom line P&L, right? So you want to know what things are on the tape. All right, so here's the risk disclaimer for tonight's video webinar. Please go through this at your own leisure. Make sure you read it. But everything that you're listening to is for information purposes only. No recommendations, no, nothing like that. No, I'm not giving any advice. This just is all for information purposes only. All right, so that's the major reason to go through this risk disclaimer. But that's basically the gist of it. All right, so my background. I've got a pretty extensive background. I traded institutionally for top tier hedge funds, your biggest institutions out there. And what I used to do is block trade for them. So I used to do this in the product mostly of ETFs. So for example, when a hedge fund wants to come on and put on big size and they want to do it quickly, rather than trade electronically, what they'll do is they'll call their broker, or they may call a couple different brokers and ask for the best price for something. They would either basically say, hey, I need a market in 500,000 SPY or a million shares of Q. Sometimes they wouldn't give you direction, so you would have to say, oh yeah, for Qs I'm X price at X price, maybe or a penny wide or 2 pennies wide on a million shares. So that's SPYs and Qs. But other times for things, and I'm going to go through a couple examples so that you can get a feel for this. But on something that's like XRT, the retail ETF, or I don't know. XLK is pretty liquid, but just looking at my watch list, let's say XLB, the material ETF. A hedge fund wants to buy 500,000 shares of that. You can't just buy that on the screen. It's too big. The volume is too big. So a market maker or block trader will take a look at the liquidity that's available to them in not only in this case in the ETF but the underlying basket, because that's where the liquidity is for ETF trading, is always in the underlying basket, or usually in that case, or if it's SPYs, it's also futures. So they would see what kind of liquidity is available. So then they would make the appropriate market. Now, a lot of times the broker who's making that market needs more liquidity than what's on the screens. So they may actually say, hey, you could buy 1 million shares, but it's going to cost you. It's going to cost you 5 cents above the offer. Why would a hedge fund pay a couple pennies or 5 cents above the offer? Because it's huge size that they're requesting, and the broker's is going to have to spend some time. It could actually be like a half a day or even more than a day to actually trade that type of size. We're talking about $50 million, $100 million. Sometimes it's much more than that. Sometimes it's $100 million or a $200 million order. So why am I going through all this with you, talking about ETFs and making risk markets and block trades? Because it has the same similarities that it has with trading options and some of the option prints that go up every day. So that's the main takeaway that you would want to see here, and that's how I can break this down for you. And I will say this: I'm not being I'm not boasting or anything like that or bragging, but I used to do this for a number of years. So I am pretty much an expert in making markets for big institutions. A lot of the guys on Twitter that you're going to find have never traded institutionally. And every once in a while, someone challenges me and I'll ask them, who did you use to, what do you mean you think this? Who did you work? How do you know that? Who did you work for? Where did you make markets? And then I get crickets on the back of it. So again, I'm not bragging, but it is my background. I did this for a long time. I did this through your most volatile times in the last 20 years. I did this through the flash crash. I made markets for hedge funds. I did this through 2007, 2008, which the volatility, we joke around about the VIX. There's no volatility right now. VIX is around a 10. This is when the VIX was north of 50. So, it was crazy times back then. And that's when I used to make markets for hedge funds. So it was nuts. And also the amount of risk and leverage that hedge funds were doing back pre-financial crisis was off the charts compared to how it is now. So that's a little bit about my background. I was also president of the baseball card club in 5th grade. So, I've got that extensive knowledge going for me as well. I always have that in there as a joke because I take pride in that. That's when I actually first started a trade, was back in 5th grade. So it's a little joke that I've got in there. My Twitter handle is @CFromhertz, where you could see what I do on a daily basis. But so the first thing that I want to go through is identifying aggressive option activity, and we're going to go through a couple of those terms. So identifying is key to this because there's a difference, right? So first of all, reading the tape, right? It's the first bullet I've got, and I'm going to go through this in a couple different. I'm going to bounce around basically in a couple different directions because I'm not a PowerPoint presenter. I'm a trader, so my PowerPoint presentations are not good. Full disclosure. So we don't always know what they're doing, right? When we're reading the tape, so we're looking for hints. We're looking for ways to kind of figure out, like process of elimination, what they're doing. And this is important because it's a big difference, and why I kind of follow the tape. And I'm going to talk about my strategy as well. That's going to be part of this presentation as well. Just identifying trades, and just because something was aggressively bought or sold, it doesn't mean that the stock is necessarily going to go up. It just means that someone has a high urgency for buying something, right? And it's a different story when somebody has a lot of urgency and intent. We used to call that back in the day when a trader has an axe. A trader axe means they either have knowledge of something, not necessarily knowledge of something, but they want to get done. They want to put on a trade quickly. They've got a big urgency to do it. they're axed to buy. So there's now you could read into that of why they have reasons to do it, but think about when you purchase an option order. Sometimes when you have when you want to get done in something, let's say that the bid off the bid ask, let's say for an option is, whatever this is, XYZ stock. Say it's 50 cents at 55 cents. Or let's say let's say it's the bid ask spread is 10 cents wide. So 50 at 60. Right? So if you didn't really have if you were more price sensitive and not so concerned about the trade, maybe you would bid mid market, or maybe you would bid, put your where you want to buy on the bid, because you'd rather pay 50 cents than 60 cents, and you're not really, um, you can kind of sit and be patient. You don't really have a theoretical reason where you have to buy it this second. So you kind of sit at 50 cents and 55 cents. Maybe you get filled, maybe you don't. Maybe you try again later. Not a big deal. But when something's going on and you have a reason to buy, you want to get done right away. Sometimes, and what I do on a small order, I don't do this a lot, but I'll pay if the bid ask is 50 cents at 60 cents, rather than try to get the order done mid market, which is a good fill. Sometimes I'll actually put my order in at 65 cents. So, because I want to I would rather get filled if I think something is going up quickly. I would rather just get filled and sacrifice 5 cents or maybe even 10 cents, because I think that the stock is moving quickly. So I'm an aggressive buyer. I have an intent to buy. So the market's 50 cents at 60 cents. Maybe I'll pay the ask, right? Because I think it's going much higher and I think it's going quickly. So I'm not messing around with trying to get better than the 55 cents and risk not getting filled, right? That's the risk, that that if you're trying to get a good price, sometimes the market moves and you don't get filled, right? So that exercise that I just mentioned that you may do sometimes when you really want to buy is the same thing when a big institution, a hedge fund, when they want to get filled too, they'll call up the broker and say, "Get me done. I'll pay up to, if the bid ask is 50 at 6, just get me done. I'll pay up to 65 cents. I'll even pay up to 70 cents for a bigger order." So that to me means a lot more. And when looking at these transactions all day long, the ones where somebody has that urgency to get done, there could be more to it than other orders that are on the tape, especially when they do that several times. So I'm going to talk a little bit about repeat orders as well, but there's definitely a difference in urgency and intent, and a lot of times that when you're narrowing transactions down by only looking at the most aggressive trades, it's more material than someone who's where you can't necessarily tell, because you can kind of mark the tape a little bit when you're trading options. You can actually push a market up a little bit and then put your big order up, and it goes up mid market, and you can't really tell if something is bought or sold. So by looking at something that is trading above the ask, and when that happens, when somebody trades above the ask, they're what's called sweeping all the exchanges. So going back to my example where, hey, I want to get done, I'm going to set my offer at 65 cents when the bid ask is at 50 at 60, and I'm ensuring myself to get done. So what I'm doing is I'm sweeping all the different exchanges and taking all those small orders and making sure that I get done up to 65 cents. So how will that trade be marked? It'll have a sweep next to it, because that's essentially what they're doing. So let me show you an example of what this looks like both in options and in stock. So let me just cancel out of here. So let me show you. It's easy for me to give you an example on a chart. So I went through some transactions. This is my screen on Bloomberg where I can look at prints on one of my watch lists that I have. This is a watch list that has all ETFs. So I could see any block prints above 125,000 shares. I could put in whatever I want, but that kind of helps me look for some trades. So one trade that caught my eye earlier was the home builders ETF. It's actually called the home construction ETF, but it's really home builders. Weird name, but it's ITB. There's a block of 418,000 shares. So I don't know what that is just by looking at the block. Who knows? It could be a sell. It could be a non-aggressive buy. I don't know. So I have to do some digging into figure out what the hell the client or what the hell the fund is doing. It's a pretty sized. It's a pretty good sized trade. It's a $16 million trade. It's not humongous, but it's a $16 million trade. It's got some meat behind it. All right. So if I bring up another Bloomberg screen, which I've done this. And if I just look for trades, I'm just looking for prints above 100,000. I could put in 125, whatever. So for ITB, and I could see just the prints in this ETF that were over 100,000. So you could see our print that we were just looking at for 418,000. That was done at so 1313 is a little bit after 1 Eastern. You can see there was actually another print earlier in the day. There was 200,000. So there's an arrow, an up arrow next to it, which means it probably went above on the ask side or above. And take a look at these modifiers that are that are labeled on the next to the print. So notice one is IS. So it's basically the same thing that you see in options. This means sweep. It means same thing as it does in cash, as it does in options. This order was swept. So let's take a look at the tape. Let's go to the videotape and let's look at the chart just to see if you could tell if this order was bought or sold. So now we've looked at this is the time in sales. Now let's go to the chart. And I think I have a chart up of today of ITB. So let's switch this around just so that you could see it on one screen. So this block order happened at, like I said, a little bit after 1 o'clock. So let's zoom in just on the hour. So zoom, and I just want to look at maybe 12:30 to 13:30. All right, so what time exactly was this? So I'm just zooming in on an hour, 13:13. Well, look at what happened here at 13:13. Can you guess what they did here based on, and I'll zoom in a little bit further. Now we're going just within a 20-minute section. Here's 13:13. Guess what they did? Guess what this client did here? So if you're responding back to me or if you're saying buy, that would be correct because look at where the confine of the market was. 39.80 was where ITB was trading. What did they print this transaction for? They printed it all the way up to 89 cents. So they really wanted some room to this. I personally would have not put the trade up that high up. That's almost 10 cents higher than where the stock was trading. So that's a buy, right? And so again, going back to what we said in the first couple of minutes of the webinar, why would the broker print a customer up that far? Because they need room to hedge it. It's a pretty decent sized trade. It's over 400,000 shares. Let me bring up one more screen. How many shares does ITB trade in a day? 2.6 million shares a day, right? So you can, sorry, I know where to look, my eyes know where to look, but sometimes I don't explain. The average volume is about 2.6 million shares for ITB. So you're looking at a block of 418,000 shares. 418,000 divided by the 30-day average volume, which is right around 2.7 million shares. That's about 16% of the day's volume, right? So it's significant. Again, I'm surprised that they printed it up that far. I don't think they need that much room. I think that's a bad print that a broker. I would have only done personally up 3 or 4 cents, but hey. So it is what it is. So that's 16% of the day's volume. They're going to need some time to be able to hedge that for the hedge fund, right? So again, just going through the mechanics of this, hedge fund calls the broker, says, hey, I want to buy 400,000 shares. Where can I do that? The market right now, the price is $39.90. Broker says, well, I'm going to need some time to hedge that transaction. So you can buy those about 8 cents up. That price apparently was okay with the hedge fund. They said, okay, I buy there. Now, what happens is that's it. The hedge fund bought. Now the broker is short 400,000 shares. So they need to start buying in the open market because brokers really don't want that risk. All they're doing is facilitating clients or client orders for the most part. So they need to go ahead and figure out how to hedge themselves so that they don't lose more. The broker is just trying to earn the commission on the trade. They're not really trying to make a call on being short home builders, so they have to go out and buy in the open market, and they'll also go ahead and buy the basket of Pulte, D.R. Horton, Toll Brothers, and so forth to get themselves hedged appropriately. Like I said, the basket, right? So that's where the liquidity is. So they're doing all these types of transactions they're doing all these types of trades in the background. They're going out and buying this whole group so that it adds up to 400,000. But that's a little bit about market making for ETFs, which is outside of this. The bottom line is they needed more room to hedge that transaction. And you can see what ITB did after that. They actually drove it up to that price thereafter. So, what their final hedging price was on that, I don't know. But so you could see now that would show up if this was an option, that would show up as sweep because they paid above the price. So again, it kind of means something when a hedge fund has an axe to go ahead and buy. That's a lot more than looking at other transactions and seeing a block go up where you just don't know for sure if they're buying. So like I said, it means something. Okay, so let me go back here. So that's a good example. So that's what a sweep is, and that's basically what I concentrate on in the room. We do look at other big block trades that will show up, but the most important ones are the most aggressive. So going back up here, like I said, I was going to jump around here a little bit. Oh boy. And so I want to just talk about a couple concepts here. Everybody always talks about unusual option activity, and every once in a while I get somebody in my room, in the trading room, and they say, "Yeah, I want to know about unusual option activity." And I'm like, "Well, first of all, I don't do that. I don't just look at unusual option activity. I don't really care if 1,000 contracts go up in a name that doesn't trade a lot of options." Because it could be 1,000 contracts for 30 cents. To me, it's the aggressiveness of the order. So I would actually, instead of calling it UOA, I would call it aggressive option activity. So AOA. I have here. I'm making a little joke here. It's fun to talk about at parties. Oh, there was a block of 1,000. 1,000 contracts that went up, and it went up mid-market. Yeah, it's never happened in that name. It's rare in that name that it's all option activity. But I don't really care about the unusual option activity because a lot of times you have to realize people are not always using options for speculation. They're using the hedge funds use options as well for hedging. Now there's a big difference between the urgency when you're speculating and when it's urgent. You're going to do one of those sweep trades. You're going to make sure that you get done, right? You're speculating, you have an urgency to get done, you've got intent. On a hedge trade, let's say we're getting into earnings and let's say you're short a stock. Let's say you're short Under Armour, which just reported the other day they had horrible earnings, and you realize, hey, we're headed into earnings. I should probably hedge some of my short, and I should probably put on a position of long calls, right? So they go ahead and do that. They don't have a big intent. They just know that, hey, I've got earnings going up ahead, and I probably should be hedging my short position because I've got event risk, right? Which is earnings, which anything could happen on earnings. A lot of people don't know. So what they do is they hedge part of their position. So you could say, oh wow, somebody looks like some calls of Under Armour went up on the ask, which we saw that a lot. Oh geez, now I'm going to have to go back. I could show you Under Armour, which again completely did horrible, but you could see, look at the calls that went up. So if you're not interpreting this right, this was not a sweep. This was just a block of 5,000. This particular block, which I'm zeroing in on, was a block of 5,000 calls, weekly calls, at 17 and a half strike, and it looks like they paid 81 cents. It was not aggressive. There was some that also went up on the bid side at 19, right? But someone looks on in Thinkorswim, or they just look and they say, "Oh wow, there's 5,000 calls that went up. Oh, somebody's thinking Under Armour is going to go higher." So this most likely was a hedge that went up, and it did not go up aggressively. So there's a big difference. And it's another thing that I get questions from people who are not in trading rooms, or they don't have trade alert, and they're just looking at big blocks and they're not looking at how they're trading. I mean, so this is what you're avoiding by being able to tell if it was aggressive or not. Right? So just because, again, there's calls that go up, it's the urgency and it's the aggressiveness, not just because it was unusual. Sure, it was unusual, but it just, I mean, here's another one. Pre-earnings, 4,900 calls go up. And somebody asked me about this on Twitter. They're like, "Do you see all the Under Armour calls that are being traded ahead of earnings?" And I go on my blotter because I know they didn't go up aggressive. I'm like, yeah, but they weren't swept. It wasn't marked as sweep. It went up mid market. So they didn't have a big intent to do that. They're probably hedging a short stock position. And you could see what Under Armour did. So this is the transactions that we kind of use a process of elimination and say, hey, we're going to ignore those orders. And just to going back again to kind of reading this, and again, I'm not dogging. I don't know why I mentioned Thinkorswim. I think because when I gave the webinar Monday night, somebody said, "Yeah, I saw this in Thinkorswim. I saw a block that went up." If you were trying to do that and not looking either at Trade Alert, or if you're not in a trading room, you are doing yourself a big disservice because you can't tell. There's no way that you could tell using Thinkorswim or using another broker that's just identifying volume alone, right? Again, I'm not saying anything bad about the brokers, but it's a very big difference between how the orders, reading the tape and how they're going up, how they're presented. So if you're trading a big portfolio of options, and you've got a meaningful portfolio, and you're trying to go and look at volume and not distinguishing between something is bought or sold and making decisions on that. Please spend a little money. I would love it if you try our room, tribeacatradegroup.com. You could try it for half off the first month. So just $69 a month. After that, it goes up to $129. This is such a little cost compared to somebody makes a bad decision like this and they go long Under Armour because they saw calls and they lose a couple $1,000. Like that pays for that pays for 2 years subscription. Or even 500, you lose $500 by making a bad judgment. That's, a couple months of the trading room, and you're getting a lot more than that. So that's just a quick note about that. But I see people all the time ask me, they refuse to either spend the money. Trade Alert is not that expensive. It's like $350, $400 a month. It is worth the investment if that's what you're trying to do. Because I see guys all the time who will not go into trading rooms. Now, granted, I used to be a part of a trading room, and it was horrendous. So I understand people they may have gotten a bad taste in their mouth from going to a trading room. We don't do any of that. I'm there to help. I'm not there to jump up and down about how well I traded for the day. I started a trading room to help people learn how to trade and to try to help them make money. That's the bottom line. I don't sell people indicators every month that tell them that they can make potential profits. So I don't do any of that. So check us out for a month for half off. And I think you'll be pleasantly surprised at the level of information that we provide in our trading room. I spend $3,000 a month on trading costs. I don't know anybody who does that. I know most option rooms they pay for Trade Alert, but I pay for Bloomberg. I pay for a couple other services so I can get the best information for my clients. So just that alone, what I provide on a day-to-day basis, both pre-market and during the day, is you have some trader's edge just from the information that I provide. So enough about that. But again, the main point here is don't make this. Do not, again, just for information purposes only. This webinar is, but I would not be making any decisions based on if you see just volume alone in an option. That's insane. All right, so let me just go back to the PowerPoint. So we've talked about, let me just give one more example because I see this on Twitter all the time where somebody says, so this is another thing that drives me nuts. It's a pet peeve of mine. People talk about, again, unusual option flow, and they will say, wow, this option is trading 10 times normal volume. Here I have an extreme example. I'm saying even more, stupid is it's this, the options in this name are trading 100 times normal volume, but let's just say 10 times normal volume. And they get people to buy into this. Well, what price do they trade it at? What do you mean, 10 times normal volume? So what's more, so I have here, so what? What's more important? Somebody who trades 50,000 contracts for a penny or 500 contracts for $4, right? So again, this is kind of an extreme case. 50,000, maybe I should have done 10,000 contracts, but 50,000 contracts at a penny is $50,000. So that's $50,000. But someone's going to say on Twitter, oh, 100 times normal volume traded today. And they don't tell you what the price was. They don't tell you if that was really market moving or not. It's insane that people do this. I think these guys are fugazis who do this type of thing. So if it's just 500 contracts at $4, right, 500 contracts is probably not going to be, then you can't go on Twitter and say, oh my God, it traded 10 times normal flow today. But 500 contracts times 4 is $200,000. So again, it doesn't, when you hear this type of thing, and I associate this with UOA, it really doesn't matter the multiple times of volume that a contract trades. It's more meaningful if, hey, somebody bought 500 contracts, they lifted the offer, and it was marked sweep. And that's a $200,000 block. All right. So that is much more important to me than the actual size of the contract on the tape. So I will refer to that as aggressive. Aggressive. Again, in this situation, I'm saying that they're basically, this is being tagged as a sweep and they're paying above the ask, right? Big difference. So we talked about this urgency intent. We talked about what a sweep means. We talked about process of elimination. A couple other things to kind of mention to you. We see as well why you can't just rely on volume. Sometimes shares are crossed, meaning somebody has a position of stock. Maybe they have 100,000 shares of stock and they don't want to own the stock anymore. They'd rather hold options, right? So you'll see a big amount of volume go up on the tape and it says buy right next to it. That basically means that they're taking their stock position and they're substituting it for options. So to me, somebody will always ask me, well, what do you do? How do you interpret that? And I tell people in the trading room, I ignore it because it's not market moving. They're not putting on any new exposure. It's one for one. So that's the situation. Another term that we see a lot is risk reversal. So what does risk reversal mean? It's essentially when somebody buys calls, and what they're doing is they're selling puts. Realizing when you sell either calls or sell puts, you collect the premium. So let's say you sell puts and you collect $1, and then you take that dollar that you're receiving. It's a credit. It's what's called a credit, either a credit spread or credit transaction, and you're going to actually go out and use that dollar to buy calls. I'm trying to think of one that we recently saw, but nothing is coming to mind. But that's pretty aggressive as well, because not only do they think the stock's going to go up, but they don't think it's going to go down either. So sometimes they do this out of the money, where they sell an out of the money puts, and they buy the out of the money calls. So that becomes pretty relevant because, again, they have the confidence to sell puts thinking that the stock's only going to go up or at least stay flat and go up from here. That's basically a synthetic stock position, right? When you do that, think about how a chart of a stock the risk profile is. You have all the upside potential, and you also have downside potential. You have downside risk until the stock goes to zero. So when you sell puts, you have risk all the way to the downside to zero. So that's called a risk reversal, and it's pretty aggressive. It's pretty aggressive. So we look for those as well in the room, because again, someone is so aggressive that they're selling puts. So that's important as well to look at risk reversals. We see that sometimes after a name is sold off a lot. Someone will say, okay, it's gone down so much that it's not going to go down anymore. I'm selling puts and I'm buying calls. All right, so that's important as well. One other, I just remembered something else here. One other way when we talk about normal time volume, right? The other thing that you can do to see if it's really unusual well, not so much aggressive, but if it truly is trading something at multiples of volume, you can convert an option position to stock, and then figure out like how many shares that was. So, for this Under Armour order, I should be able to tell here the delta is about 52%. The premium, it should tell me what the impact, I think they're saying impact is about 250. So without doing the math really quick, they're saying that this 4,900 of Under Armour November 1, 16 and a half calls is equivalent to 254,000 shares. So going to the Under Armour stock, right? So basically how many shares of stock they're trading based on how many contracts of options. So if you go to Under Armour and we go back up here, it trades 5.3 million shares a day. So is 250, what did I say? 254,000 shares? It's about 4.7% of the day's volume in Under Armour. So it's a decent sized trade, 4.7%. But again, if someone is saying this on Twitter where they say, hey, the option's trading 15 times normal volume, ask them, say, well, what does that equate to in terms of average daily volume of the stock? Most likely they're not going to be able to answer that question because they're only, again, I'm really throwing people under the bus. I'm not mentioning anybody in particular, but just be careful of these people because some of them are one trick ponies, right? They can't do the math to figure this out, which is very simple. And you want to have this knowledge. You want to be able to say, okay, well, that's not really that unusual because again, if you're making a decision based on this, just because somebody's jumping up and down and using all caps when they send out a tweet, it makes it look like, oh my God, something crazy is going on. Well, it's really not that crazy. Sometimes when you break it down and go through the math and figure out how many shares that equates to from option contracts, right? It's important. It's important to know how to do these things. And again, this is what we do. I really try not to, my intent is not to excite people on something. And again, a lot of these guys are pumping and they're dumping. They want you to get excited about a stock because they're in it and they want you to buy and make the stock go up and then they can sell. So it's crazy, but that's what these guys do. I've seen it firsthand. All right, so I hope that helps a little bit. That's identifying option activity. I can't ask you if there's any questions at this point, but that's basically, in a nutshell, what we're looking to do, and really separate the orders that could be hedges from the speculative orders. All right. So how do I use aggressive option activity? So I mentioned the term one trick pony. I do not just look at just purely option activity just because something was bought or sold. I'm going to buy it. Uh, that is also one of the stupidest things you could possibly do because you need to have some other basis. You need to have a trading system, right? So, what am I using the aggressive option activity for? I'm using it for idea generation. So I'll give you an example, and I don't know if it's going to go this far back, but this is a perfect example. I don't think it's going to go back that far. I think it may have just fallen off the system. So there was a trade about 2 weeks ago in MTN. This is Vail Resorts. This is a group that's been the resorts have been done really well this year. But I'm familiar with this company. I ski, and I've looked at this over time, and I've noticed this thing's been in a big uptrend. And I've said to myself, I've seen this chart before. It's a great looking chart, and I've said, hey, if I can only get in when this name dips, right? So I was trying to think if I have the date of the MTN position. Let's see if I go back in trades. So it was about 2 weeks. Oh, here we go. I found it. I found it. I think I did. I just saw it. That was a lucky. Now I just need to find where I saw it on my screen. Here's my exit, my first exit. Here it is. Okay, so this was on October 17th. So yeah, it was about 2 weeks ago. I think it just fell off the trade alert system. But we saw some November calls that went up in MTN, and they were aggressive. It said sweep next to it, so we knew that it was bought, or we had a higher probability of identifying that it was bought and bought aggressively. So 1017, I think, was in here. 1016, yeah, 1017 is when I put the trade on. So it was right here when this name dipped. So I don't watch this stock every day. I look at it from time to time, and we've never seen an aggressive option order, at least that I can remember in the last year, that somebody bought options in this name. So I looked and I said, well, what do they buy? They bought November options. I don't really want November options at this point because I want to put on a swing trade. And as we know with front month options, or it was probably a week before options expiration, August options expiration, it's close to front month. I want to let this thing run and I want to be patient with the trade. So I didn't follow exactly what was on the tape, which was November call options. I said, I may want to hold this for more than a couple weeks, or more than a week, more than a couple weeks. And as you know, with front month options, they decay more than further out options, right? There's a curve that you could look at the theta curve for this, and it really picks up in the final month of options expiration. So the swing trade that I wanted to put on is something for a little while, and I want this thing to continue with its upward trend. So great spot that somebody came in. Great idea that this gave us. So I went ahead and structured a trade out to January. This is the trade that I structured. I just decided to go out to January, and I looked at the chart, and I said, where can this get to? Which is something that you should always do. Where do you think this thing can get to? And I said at least 230, maybe 230, 240 by January. So look at what the stock has done since then. So we've already hit 3 targets in this trade, and I'm leaving the rest on now. But we put this trade on. I actually just took a target in this today at 230. Fast forward to today. And I took this trade out for a double. Took a target today at a double for 460. Now I also did buy a very small amount of the November options too because I really liked it a lot, and I made a double on those as well. But the heart of my position was going out to January. So again, another misconception, which this is all about misconceptions. But you don't always have to trade what's exactly on the tape. Again, I used to see somebody else in another trading room, and they're like, or I get this question a lot from new members who have been in other trading rooms. They're like, why aren't you buying the November options? Because that perspective, whoever decided to buy that institution, I don't know what's in their head. All right. I need to figure out what I want to do and how I'm going to manage it in my book. So as long as the one thing that's an advantage of sticking to where the volume is, the big volume is, and where the open interest is, that option strike will probably have more liquidity to it. Right. So that's advantage of sticking to the volume. But it doesn't mean all the other strikes are going to be that illiquid. I went out to January and I said, you know what, maybe it's a little bit more illiquid than the Novembers, but it wasn't that bad, and it was worthy of me putting on a January trade. And you could see I've already doubled my money in the last target that I've taken. So So you don't always need to do exactly what's on the tape. Put it into your own system. So you need to follow a trading plan. You need to put on what you're comfortable with, and you need to figure out where the trade's not going to work. They're not that person who bought the November options. I could give you countless examples, but first of all, they're not going to call you and say, "Hey, Christian, yeah, I put those options on a couple weeks ago. I'm going to take them off now, or I'm going to hedge it with stock." So you don't know. You don't know when they're going to do that. So I basically will use the reading the tape and the option activity for a trade idea. Once I see the trade and I decide to put it on, that's it. I'm on my own. They're not going to let me know what's going on with the stock or that the reason that they originally bought the options for. They're not going to call me and tell me that reason's not there anymore. So you're on your own once you do that. And so getting into that habit of being confident enough to decide what option makes sense for you and how you're going to manage it, and forget about what that original buyer is going to do or doing, because again, they're not going to call you up and tell you, oh, when the stock goes down, they may not be able to manage it well. And we could go over again countless examples of how hedge funds don't manage trades properly, right? All I have to talk about for a minute is my friend Bill Ackman, right? He may have bought all kinds of options in VRX, to use this one example. So he may have bought options and it may have been a good idea, but you have to use your own trading system. For me, if I would have bought options here or in here and had a nice gain, or stock, or if I own the stock and it broke, for my system is if it breaks the 200-day moving average, I'm out. Now maybe I might not have caught it here. Maybe I would have said, hey, here, depending on where I put the stock on or the option on, maybe hopefully I had a profit, or maybe I had to take a loss. But this guy held on to it all the way down here. So you can't take this for granted that these guys, just because they're getting paid a lot, and it is what it is. If they work for a hedge fund, they're getting paid a lot. Uh, that their judgment is perfect, because again, you look at hedge fund performance this year, and a lot of them are not beating the S&P, right? They're not doing it. So if they can't beat the S&P, maybe they've got a good idea, but maybe they're a shitty trader. Maybe they're a great portfolio manager, but they can't trade for a lick. So this is a good example. Investors give this guy money to manage. And what did he do? It broke the 200-day moving average. He probably added to it, added to it, added to it. When did he get out of the stock? When it bottomed. I think he got out of the stock when it was around like $12 or something like that. I mean, you're kidding me, right? So you can't just follow blindly. Again, I'm really picking on this guy, but I don't mind because he makes a ton of money and he doesn't have to worry about me. But he went into Chipotle. Once Chipotle broke the 200-day moving average, get out. That's it. Game over. Or have some other support. That's my trading system. I mean, look at what the stock has done since he's gotten into it, and he's just holding because he has no trade. Again, I don't know what his trading plan is. But you're going to hold this thing as it goes below, breaks down, and is in a big downtrend, and you're holding and you're holding and holding. You got to be kidding me. That's not how we trade. That's not how you make money trading. Sorry, Mr. Ackman. We as traders have to have a trading plan and have to be disciplined. He's more of a fundamental guy. We can't trade on fundamentals if you're, a retail trader. I trade on technicals, and that'll tell me when to exit for a small loss. No big losses. Avoid big losses, right? We want big winners and small losses. And it's going to happen every time. Somebody gets into a trade. You have a 50% shot. Maybe if you're really good, you have a 60% shot of it being a winning trade. But the trade management is the key. And people overlook that. They think their personal judgment is better than everybody else. It's just like sports gambling, right? People think, oh yeah, I know sports better than everybody else. And it's not easy. So taking your personal judgment and sticking to rules, that's a whole nother webinar that I want to give. But the more disciplined you can be, and sticking to stops and so forth, I think the more profitable trader you're going to do. Now you also have to let the winners run too. You can't take the winners off, right away. Um, and so anyway, again, that's a whole nother topic. So I'll leave that for another day. So what do I look for? Just like an MTN, this is textbook for me, and that's why I'm spending so much time on it. But you go back to MTN. This year, 2017, has been a great year to whenever we get some type of a dip to buy it. So we had a dip here. I think the 100-day moving average, which I don't have on this particular chart, probably here, was my stop price, and you can see it never really broke. So that was my stop for MTN. Was the 100-day moving average, and so we bought on the dip, and it was a great. It still is a great trade. I still have it on, but like I said, took a portion of that trade off today for a double. Now, if it would have broke the 100-day moving average, I probably would have dumped it. Right, that's my risk. So in this type of trading, right, we see a whole bunch of trades every day that are aggressive. Right, here's today's blotter, which was actually kind of lackluster option activity. Yesterday was actually a little bit better. The Friday was really good, but you can't take every trade. So just like baseball, you want to be picky and you want to be consistent. Consistent meaning that try to keep the trade size the same for every trade. Just because you really, really like a trade and it looks great on the tape, I typically I get into trouble that way. So when I take an outside trade and it doesn't go the right way, I could have, seven great trades and I could have one bad trade, and because I put bigger size on, it's negating all the gains from my seven other really nice trades. So what I've learned to do over the years is be very consistent and try to take my judgment out of the equation. Because really, again, it's really a 50-50 shot. Even though the setup could look great, they bought calls, looked wonderful on the initiation of the trade. It doesn't necessarily mean that it's going to translate to profit. So I try not to really, even though I think something is a great trade, take double the size of trade that I normally do. What can kind of help in this situation is maybe use like bands, I call them. So if your normal trade size is, let's say, $3,000 or something like that, and let's say it's like a 20 lot is what you normally trade. If you really like a trade, maybe take 23 contracts, right? There's little things that you could trick your mind like this to say, yeah, I really like the trade. Maybe I'll take a couple other more contracts, and then you're taking three more contracts than you used to, which is really not going to hurt you any very badly. But you're kind of tricking your mind in saying, hey, I'm going to take a bigger trade because I think this is a really good signal. Meanwhile, you're not really putting much more risk on than your normal appetite of a 20 lot. So again, try to be consistent. Wait for your own pitch. I love to have baseball analogies because I really think that they come into play a lot. Plus, I like baseball a lot. I know a lot of other traders do that as well. You could wait. The thing about trading, option trading or just regular stock trading, you could wait for your pitch. So when we see trades that hit the tape, you could take as many strikes as you like. No one's going to call you out. So be very picky, which I have in the bullet ahead or in front, and take your time with finding a really good signal. It's tough. It's one of the things that we battle with all day long. Is sometimes we're ready. We've got a cash balance. We're ready to deploy it, and we see the first trade on the tape, and you're like, boom, we go after it. So, and then an hour later, we see like a better looking trade. And then an hour later after that, we see an even better looking trade. And now you've maybe put on three trades, and now you can't manage all those trades, including the existing positions that you have on. So you have to really be picky. Do I have another slide for this? I don't. I thought I had another one. But so I mentioned this one already. I thought I was going to talk. I'm not sure if I talked about on Monday position sizing. Yeah, basically for options. So we went over this already. We don't have to follow exactly what on the tape. If somebody bought weeklies, you can actually make it into a swing trade if you like, even though they only have the time frame of maybe a short-term catalyst. But if you're not comfortable holding a weekly, which I'm not for a swing trade, you could structure it any way you want to, as long as the it's a somewhat liquid option contract. Um, you could also make things into a call spread. The MTN example I gave you was somebody bought outright calls. I was a little bit more comfortable with that trade for a call spread. So you could do whatever strategy you want to do. You're not limited. Also, so before I get into the next bullet, because I don't have that much more to cover because I've gone through things quickly, like I said I was going to, and try to keep it under an hour. But same thing with I went into like waiting for your pitch. Managing option portfolios are difficult, right? These are stocks on steroids. So being cognizant of how many positions you have on. From everybody has a different number that they're comfortable with managing and have different capacity. I generally don't like to put on more than 20 different swing trades on. I think 10 is really a good number. But you have to be cognizant of that in managing. And again, that's kind of another webinar on strategy. But I just wanted to kind of foot this to, how to manage your portfolio and how to go from using aggressive option activity and putting that in your portfolio. So that's the thing that you want to be a little bit cognizant of. The more and more positions that you get up to, the harder and harder it is to manage your portfolio, and the easier it is for you to miss something and not be on top of your positions. So I like to talk about that because, again, I think it fits into this webinar of following aggressive option activity and managing positions and how to be a profitable trader, right? We don't want to get over our skis in terms of risk. The same thing with cash, having cash as a position. When you get a market dip and the shorter duration options that you're holding, the more that's going to hurt you. And then the other rule that I have is for having cash on the sidelines is you need to have that cash position for when we're going to get a market dip, because that's the worst position to be in when a market dip comes and everybody's buying the dip and you don't have any cash to be able to deploy. Horrible position to be in. So again, I try. This is what I do in the daily in the trading room. I try to give as much instructions about this and provide some guidance. So lastly, so again, I'll hit this bullet first, and then I'm going to talk about options as a sentiment indicator. Like I said, I would skip around, but yeah, you must follow. Most important here, and that's why I've got all the stars next to it, is you must follow your own trading system, and the trades that you take must be in the confines of your system, right? So for me, going into any particular transaction, I'm a trend trader, right? So I trade with the trend. I want to own stocks that are going up, and I want to either short or avoid stocks that are going down. So I don't know. We can go back to the Chipotle, for example. Anything below the 200-day moving average, I really try to avoid taking a long. Every once in a while, I'm tempted into taking a long position that is in a counter trend trade as long as I have support. There's something that I just took as a counter trend trade recently that worked out. But basically, what I will do is take a smaller size. So if my normal, go back to what I mentioned before, if your normal size is 20 contracts, maybe in a counter trend trade, I only take five. And I try to grasp onto some. Oh, Celgene. Celgene is one. So I have this trade on. It did break below the 200-day moving average, which is all the way up here. I waited for some support that I could trade so that I could foot to. So what did I find here on the weekly chart? So I do use value areas. They give you really good support and resistance level. Here's a good example, 97.5. That's your bottom of the 2017 value area. And you could see how last week, so this is again the weekly chart, so each bar is for 1 week's price action. And you could see that we held the bottom of value. And we've been doing, and we're holding. So what did I do? I sold the put spread below here. So I think the way I structured it, by December, I just need Celgene to finish above 100 and I'll make a lot of money. But again, it's a smaller size trade for me because it's below the 200-day moving average. However, I found another really good level of support that could help me. But again, that trade that I put on for Celgene is probably about a third of the normal position size, right? So these rules really keep my emotions and keep my judgment in check. So I recently put this in here. We have a CF trading plan that's in the trading room where I talk about technicals, what I'm looking for, position sizes, swing trading, a whole bunch of things. So when you join, if you decide to join, you can access all that. And again, associate option trading into your trading plan. That's my trading plan. You should have your own and make your trading style and write these things down. And then you should be able to reference them when you decide to do something stupid. Listen, we all do it. We all do it as traders. We make mistakes. It's human nature. Nobody's perfect. But having your trading rules written down so that you know when something fits or doesn't fit, and then you can be more disciplined. Again, what I like to say, one of my sayings that I say is, I'm more confident in my system, my trading system, than I am in any individual pick, and that helps me be able to come to terms when I'm wrong on a name, right? Well, I could say, I don't care. I don't care about this particular pick. My trading system tells me to sell it. It's breaking support that I said I was watching. I'll get out of the position. So many people do this incorrectly, and when it breaks support, they add more. It's like face palm, right? So in any event, having that trading plan really helps, and I encourage everybody who's a full-time or part-time trader to do that. So the last thing I want to talk about, almost done here. We've gone just an hour, which is perfect. I think the webinar that I gave the other night was an hour and a half. I also use options for a sentiment indicator. This is really, really good. On Friday, so I'll go to the second bullet first. Because I think things were really exuberant on Friday. If you remember, that is the day after Amazon, Amazon, Google, Intel, Microsoft all reported awesome earnings, and the Nasdaq finished up well over 2%, something we haven't, I think, well over 2%, and there was all kinds of call buying and everything, right? So you have to be careful when that happens. I usually keep my option trades, my aggressive option trades, on one page. When they start to go to a page and a half, people are just, the momentum players are out and they're buying everything. And we've seen it before. It's too much, right? And we've kind of seen what's happened since then. We haven't really moved too much this week. We had, I think, at one day, I think Monday was a nice day, follow through, but we've kind of been stuck a little bit the rest of the days this week. I think we opened up higher and we closed to the lows today. So you have to be careful when there's call buying and everything, right? The sentiment is pushed too far to an extreme. What's more important is how to use option activity when we have volatility. So there will be times, we haven't had them in a while, but there will be times where we come in and the market is kind of correcting a little bit. We do have market corrections. They're just short-lived these days. So usually we're getting, and we haven't had one in a while, but it's been, usually they're 2 or 3 days. So I don't want to be the first one in to buy the dip. Usually the dip buyers return, but you don't know if it's going to be on day 1, day 2, or day 3. In the cases when we have a little bit of a deeper correction. So I have the same playbook. When we come in the morning and there's volatility in the morning, futures are down 50 basis points, whatever, and nobody wants to buy the dip, right? Everybody says, oh, if I could only get a pullback, I'll buy. But when it happens, nobody wants to do it. Everybody's running for the hills. So what I look for is on the tape is when those aggressive call buyers start to come back. Sometimes they don't come back on day 1. When I start to see dip buying in a whole bunch of things, it's a great sentiment indicator that this volatility is going to be short-lived. And again, I don't want to be the first buyer in. Nobody does, right? Nobody wants to be the first buyer in. They want to um, and be wrong, and the market goes down another 1 or 2%. That's horrible, right? It's not you're not it's not in a good place. So I usually don't buy anything when we're in those periods until I start to see others start to pick different levels and start to buy. So that is a really great indicator. It has worked so well this year. And I'll say it over and over in the beginning of days. I'll say, let's wait. I'm not going to be rushed into buying. I don't know when I can't pick the bottom. Nobody can pick the bottom perfectly. But the guys who are buying options, when they start to buy with two hands, that's when I will start to buy the dip, and it's worked out extremely well. The last time that the Nasdaq dipped, we saw a whole bunch of call buying, which got us involved in everything underneath the sun. This was back in June where we actually had finally, a little bit of volatility where we could buy stuff on the dip. And yeah, I mean, things were just there was accumulation all over the place. Things like Adobe, things like Salesforce. A lot of the stocks that are in that IGV ETF that I make reference to a lot. This is your second tier IGV. This is your second tier technology, which has been extremely strong. So we saw buying in a whole bunch of these names. Autodesk was another one. Red Hat was one of the first ones where we saw a big call buyer, and I had taken that trade. That was back then. And you could see what the stock has done since that dip back here. It's just been on fire. So again, that's our little roadmap for when there's high volatility. It is a great indicator. All right, so that's the end of the presentation. I hope you enjoyed it. I'm just going to talk 2 minutes, which I talked a little bit about our trading room and what you get. It's a huge value. So please try it. Try it for a month. Give it a try. Don't. There's someone who I gave somebody a trial for a couple days, and they're not even in the room. So if you try it and you don't like it, that's fine. But most people who try it out for at least a week or two and give it a fair shot, they love it. I'm getting just tons of great feedback from people who are using our room for multiple reasons. So you get a ton of things. You get a great newsletter that kind of sets you up for the week, which we do on the weekend with a whole bunch of trade ideas, which a lot of them that I just put out this weekend are working really well. We trade live in the room as well. So you get to see, I manage a trend. If you're into trend trading, I manage a trend portfolio, which is beating the S&P since I set it up in March. That's a cash portfolio, all stocks, and then real time you could watch us trade options as well, and to kind of get a feel for it, get the hang of it. Either if you're just starting out in options, or if you're an intermediate to expert trader, which I want those traders in the room because they add value to the community. And that's really where we try to separate ourselves from anybody else, is we're all trying to help each other make money. So we're trying to do that together. I leverage off some of the great traders in the room, just like for option flow, right? I'm looking for ideas. And a lot of the traders in our room have exceptional ideas. So it's really great when that happens, when somebody floats an idea out there, we vet it for a minute or two. I decide to take it, and it ends up being a great trade. So we've got basically, I think everything that you would be looking for to either get started and kind of learn this business, or if you're an advanced trader, then you're at the right place as well. All right, so thanks for watching this video of the webinar that we gave on basic option trading, basic terms. Thanks very much for watching, and have a great evening.